Here we go. Cool. So welcome to Monday Masterclass number 3. I want to say 3. Number 3. We're going to talk about risk management. So let's jump into it. So we've got a few questions here, which is what we will go over according to risk management. Reduce risk if you're losing on a losing streak, 10 plus trade. Yeah, we're going to talk about these things. So that's fine. So yes, as I said previously, the 3 sort of main things I would personally suggest for looking at and focusing on and putting a lot of work into is your risk management, your trading plan, and obviously the structure of price. Everything beyond that, in my opinion, is something that you can build upon, right? You can add to as a complement, add to build more confidence in your system, because they are the sort of foundation, in my opinion, right? The foundation of price action, the foundation of your trading as a whole, and where you're going to start seeing results. So imagine, obviously, having strict risk management. It helps with psychology, right? It helps with psychology, and the reason for that is because when you have a strict risk management procedure, you already know when taking the trade what you're risking. Now, the interesting thing is, though, I'm saying this, as I'm saying this, even me, I have a strict risk management system in play. However, even then, I still find myself stressing sometimes. I still find myself like, even though I know, okay, I'm only risking 0.5% on this, so £500 or dollars, for example, even then, I still find myself staring at the chart in MT4. Sometimes it's just human nature to want to follow and to continue to watch as the money goes up and down, right? So don't get me wrong, even with the strict management, the strict plan, and etc., there are still going to be times where you are going to be attached to your screen and your phone. But the main thing is to try and reduce the emotional side of things. Remember that when we talked about polarity and when we've talked about being balanced, our main aim is to try and remain balanced. Even if we are focused, a lot on the charts and looking at our phone and maybe spending a little bit too much time, some would say, in doing so. Even if that's the case, right? You can still have the healthy balance of knowing when, even if you're watching it, knowing that it's okay. I'm only risking X amount. So risk management, let's talk about it here. So I'm just going to put RM. So I put like R dot M. So risk management. Okay. Now, why is risk management important? Let's move this to the left over here. Why is it important? One, it's going to allow you to have a fixed risk, right, per trade. That's very important. Okay. Why else is it important? Okay. So also fixed risk. What does that mean? It also allows you to then fix your risk to reward, right? Because then each trade, if you're risking. So I'll put example of this, right? So example, I would always say in percentage wise, based on your account. So if you have a £50,000, dollar, euro account, whatever it may be, and you're risking 1%. Now, most people risk 1%, right? That's the figure that we hear the most, right? 1%. That's fine. So 1%, which would equal to £500 in this example, if we're doing a 50k in pounds account. So say your minimum risk to reward, and it's a fixed one of 1 to 3, right? Cool, fantastic. So the beauty of doing strict risk management is that you will be able to then do the numbers, right? You should be able to then do the numbers. So based on your trading plan, if your risk to reward is 1 to 3 as a minimum, for every 1%, so for every £500 that we're risking, we're looking to gain £1,500, right? So we can write this here. We can say for every £500 we are risking, we are looking to gain 1,500, right? Fantastic. That's just simple maths, that's just numbers. And what am I doing here? Oh, this should work. Extend this out. Yeah, perfect. Cool. So risk to reward 1 to 3 for every trade we are, for every £500 we are risking, we are looking to gain £1,500. So that's a good risk to reward, right? And that only works if we have a fixed risk. Now, where we see common mistakes within trading is that a lot of people will have a fixed lot size, for example, which isn't necessarily terrible or bad, but what it does is it doesn't allow you to have a fixed risk, because the lot size on, say, 0.5 on Euro GBP compared to 0.5 on GBP NZD, as an example, 2 different things. So say if we're using a fixed lot size, fixed stop loss, size as well. So say if we're only risking 20 pips on both trades, they're still going to be different amounts. 20 pips on Euro GBP is going to be more in actual value, monetary value, than it is on GBP NZD. It might actually roughly be half almost, right? So that's where you can see it's getting skewed. And the reason why is, say your minimum risk to reward as part of your plan is 1 to 3, but you're not worked out the risk per trade, but you're using a fixed lot size and a fixed stop loss. So that trade on Euro GBP might have been 1%, but then the other trade on GBP NZD might have actually been 0.5%, right? So then if that's the case, let's say if you lose the trade on Euro GBP of 1 to 3, the full 1%, £500 loss. But let's say on Euro GBP, GBP NZD, sorry, you win, but you only done 0.5%. So that 1 to 3 is actually only giving you £750. So you've lost £500 and gained 750, meaning an overall profit of 0.5%. So you see, by not having a fixed risk per trade, you're not allowing your risk to reward to actually play out. Each trade will be different. What normally happens, right? What normally happens and some of you might be able to notice this, I've noticed it in my journey, is that the winning trades end up being on the smaller lot size and the losing trades end up being on the bigger lot size, right? And how annoying is that? How annoying is that? And what does that do when we don't have a fixed risk management system or procedure in place? Is it entices us to continue to change. That what normally happens is, and our thought process is normally, oh, let me put more on because, at least then when I win, it will make sense, right? Because what's happening at the moment, I'm just kind of going sideways because I keep risking, half a lot on this trade and then that one wins. But then I'm risking one lot on this trade and I'm losing. And that's where the danger of stacking comes in. Stacking trades or order splitting, as they say. The danger is, and don't get me wrong, many people use this method. Many people use it effectively. I've used it effectively in the past too. But one thing to remember is that if we're stacking, normally what happens is we're only stacking when the trade is, we've sort of created an area. So to show an example of this, right? Say we're in an uptrend. This is our, confluence area. Say we've got 61.8 here, 78.6 there. So the fib. Oh, say the fib. Maybe something else as well. That line. I'm trying to get it straight. That would do. But instead of, so let's say instead of us having a confident area of entry, what we've done is we've highlighted this area and said, okay, we're going to enter one here and one here and one here, right? So we're order splitting, we're stacking, whichever term you want to use. Now, what normally happens in this scenario is, yes, okay, if price does go all the way through, then we get a full position on. So say we're not used to risking 1%. In this scenario, we've risked a quarter here, a quarter here, a quarter here, and a quarter there. Now we have 1% running. Fantastic, right? But then what normally happens is our stop is here, let's say. What normally happens is, if it gets to this scenario, then a lot of the time we get that, 1% loss, full loss. Okay, that's annoying, right? But then what happens if we get a winning trade? What normally happens is this. It taps the first one, we get our 0.25% on, and that's the one that wins. Right? That's the one that goes, and we haven't had a chance to put the rest of our positions on because it's gone without us. And what we normally see is price comes here and we're like, okay, let it come back down. I'll add it in, but it doesn't come back down, right? And what normally happens is in psychology, it does come down a little bit, retests like some form of support resistance that's not all the way down there, and we don't re-enter or anything like that because we're saying we want price to come to where we've entered our original position, if not below that. So the winner ends up being 0.25%, say 1 to 3 risk to reward. Again, 0.25%, they've banked 0.75%. But when they're losing 1%. So now their risk to reward is actually negative because they're actually losing 1% at a time, but only gaining, say, 0.75%. But let's say even if half your trade was got on there, you've only banked 1.5%. So you see how the risk to reward isn't stacking up now because we haven't got a strict risk management system or structure in place. And because of that, it leaves room for us to not get positive results, even if our strategy is correct, even if our strike rate is correct. It means we're still getting sideways or even negative results still. And this is where a lot of people get confusion and spend a lot of time in their trading, wondering where they're going wrong. And as I said, this can be very simple for many people. For many people, this can be a very simple concept, risk management, right? And they might be wondering, why are we doing a whole webinar on it? But the truth is to highlight where some people may be going wrong without even knowing. Yeah, a lot of people don't realize how having a fixed Lot size doesn't mean fixed risk. How by having a fixed stop loss size doesn't mean fixed risk per trade, percentage risk as well. See how I put a lot of focus on percentage risk per trade, because we need to be thinking in percentages. Yeah, that you hear percentages and pips, right? The reason we talk about that is really all we're trying to get at is that you don't want to be thinking about the money. Because when you think about the money, that is when things go wrong. That is when things go south, as they say, right? Because the money plays on our emotions, plays on our mindset a lot more than a percentage or pips. And I was saying this, that imagine if when you're trading, instead of it showing you the financial gain or loss, it's showing you the percentage. If it was showing you the percentage, I guarantee, or I can't guarantee, sorry, I should not give guarantees, but I have a thought that, or my idea is that people would do a lot better, right? Have a lot more focus and drive because they're focusing on the percentage, right? Even if you showed it in pips, it would be probably kind of cool. But I think percentage, especially in instilling that institutional mindset and instilling that investor mindset, that's probably a big reason as to why they keep it very colorful. And obviously, if you're in profit, keep it blue. If you're in a loss, then it goes red, right? And it shows you the physical, the monetary value instead, right? So yeah, so far, what are your thoughts? You know, has this cleared up a few sort of things for some of you? Hopefully. But what are your thoughts so far? And let me go through some of these questions as well. Nothing. I should let people type, give them time to type. Or no one's typing at all, and we're all good. Nope, nothing. Okay, let's go through some of these questions then. What do we have? We had a couple. How to decide on risk percentage. So risk percentage will be based on how confident you feel, what account size you're trading, etc. What parameters you might have in place. So as being part of the fund, you have obviously some parameters like the leverage or like also the no holding trades over the weekend. So, you know, or your drawdown limits, for example. With us, obviously, it's fine, 40%, but depends how you're trading. Do you have any limitations? Are you just trading personal accounts, right? So this is where it's very important to realize and how to work it out, right? So let me give you an example, right? And this is something that should hopefully, you know, open some of your eyes to a few things. I'm just going to get rid of this for a second. Now, this opened my eyes when I started trading this. So everyone always spoke about 1% risk, right? So of a, just to highlight for a second, of £1,000, that equals to £10, right? I think I'm correct. Correct me if I'm wrong, by the way, guys. So we do the same thing. We just keep going up, right? So now that's 100. Okay, cool. It's the same 1%, right? 100,000. We'll go over to a million. Oh, sorry, 10,000, right? Now, oh, messed that one up there, didn't I? Sorry, my OCD doesn't let me do it. Okay, so say we take that same example and we put in obviously the 1 to 3 minimum risk to reward. Okay. On trades, what are we doing here? So I'm just going to put obviously the return value. So this is the risk, obviously. The return value on this side of 1,000 will obviously be £30. And the interesting thing about this example is that I'm also going to show you, you know, why most people don't stick to any of these rules, you know, psychology-wise, why it takes over on small account sizes, right? And some of you probably already know it already, to be honest. 30,000. Okay, cool. Now, here we go. I've got some messages, so I'm just going to go check. That's not a million. It's a million now, Yusuf. See how you're doing. Do you enter immediately after a retracement? 6.1, you wait for confirmation before entry so you can manage your risk. I'll go through this, no problem. I'll go through those questions for you. So just as an example here, so what we got, you know, 1% risk of £1,000, £10, right? Risk to reward, if you're winning a trade, it's £30. £300 if it's a 10,000 account, £3,000 if it's 100,000, 30,000 if it's a million. Okay, now what's very interesting about this is that, say you're, so we'll start with about the lower account sizes. This is the big reason why most people don't stick to a strict risk management, risk to reward model, a plan, or anything like that. The reason for that mainly is, one, because they get access to such high leverage, so they can over leverage a small account with such crazy high lot sizes that are probably made for a 10,000 or £100,000 account on such a small account. So that's one reason. But the main reason they do that, though, in the first place, is because small capital does not entice you to be strict. Because the main reason most people get into trading is to obviously make a lot of money, right? A lot of people are looking at this last figure, probably thinking that's where I want to be, right? No one really looks at that first figure like, I want to make 30 quid, right? I want to make 30 pounds, right? And the reason is because we get into trading to make more than that. So when people are trading, say, a couple $100 or a couple £1,000 or dollars as well, or whatever currency, I keep getting stuck up on that, but whatever currency you trade with, when it's a couple hundred, a couple thousand, you're not really enticed to stick to your rules because it's not making you the money that's you're hoping for or going to change your life or that vision that you see, right? That £30, right, is one trade. Say you do, I don't know, 10 trades in a month and they all were profitable. You made £300. For some, don't get me wrong, for some in the world, that is a life-changing amount. So it's a really large amount. But for majority of people on this program, and majority of people in this webinar, and for majority of people who will view this webinar and the recording, it probably isn't a lot of money. So then you have to think to yourself, why is it that you're not being strict when it's just not a lot of money? And that is because it's not enticing you to be strict. Because being strict isn't going to get you any closer to your goal anytime soon. The main word being soon, because it is getting you closer to your goal if you do it. Because if you do stay strict, if you do stick to a plan and stick to these rules that we set in place, then you will be profitable over the long term. And see that knock-on effect of you being able to do, I don't know, say a 30% return a year on a £1,000 account, £300. Okay, don't get me wrong. But an investor is going to be looking at, yes, this account size, but more importantly, he's going to be focusing on your drawdown, on your percentage gain and loss, and the sort of fluctuation between the two, right? What he would then be able to do is, as an investor, for example, is, okay, why don't you trade on a larger account now? They might not fund it to you, but I'm saying if you do the same results on a £10,000, use the same mindset, use the same principle, will you be able to do that? Right? Okay, cool. You do the same thing. That's how you're going to get funded, through the percentage. An investor isn't necessarily staring at, oh, you're trading, £1,000. Don't get me wrong, it will be a factor, but they'll be focusing more on the strategy that you're using. Okay. Now, one thing I want to highlight as well is this. Okay, so as I said, most people say 1%, 1%. But what about this? In this scenario, and this happened to me, right? And this is the thought process that happened to me. So I was trading £200,000, right? Now I thought about it, 1%. Yeah, obviously, 1 second. 1% equals to £2,000, right? But I thought in my head, I don't need to risk £2,000. Why? Just because I can. Why? A proper risk management, why don't I do 200,000 and instead risk 0.5%, right? Because even that is worth my time, right? That's £1,000 risk. So when I'm doing my trades of a minimum risk to reward of 1 to 10, I'm risking obviously £1,000 to gain £10,000, right? So I don't need to be greedy. I don't need to say I need to, trade 1% all the time. So for example, a good example being the 1 million account, it's nice to know that 1% would just be 10,000. It's nice to know that. But even in that scenario, do I need to risk the full 1%? Even 0.5% is 5,000. Do I need to risk the full 0.5%? No. I can still make substantial amounts of money. Even at 0.25%, that's still more than this scenario over here, right? Even at 0.25%, that's 2,500 per trade. 0.25%, right? And the thing is, even with the 0.25%, right? I still, even with risking 1,000 and doing a 1 to 3 risk to reward, even that's a 3,000 reward for one trade. Yeah. No, really. I understand what you mean by the risk reward. That's what happens to people though when they think about higher risk rewards or see other people doing higher risk rewards. That's not the importance. The importance is the risk, right? So even with the million, risking 1% don't need to. Even with the 200,000, even risking 0.5%, even at a normal risk to reward, 1 to 3, risking 1,000 to gain 3,000. It's still substantial amounts of money on one trade, for example. So for example, just to make it more realistic, let's say I took a trade today. Okay, let's say I took a trade on Euro GBP and I made a 1-to-3 trade, risking 1% on 100,000. I made 3,000 today, right? That's people's, some people, the average wage in this country, that's still above that in one day. So why should I let my greed take over to just take more trades? So for example, if I'm using 200K account, do I need to, obviously don't get me wrong, majority of people want to make more money. But it's about how do I do it sustainably? So do I need to risk 1% to be able to gain the amount of money I need? Not necessarily. It also depends obviously on many other factors, such as what your sort of monthly incomings and outgoings are in your, outside of trading, just your general money management, right? That's something we can probably talk about at another date, to be fair. But yeah, I hope that clears some things up. Now to answer some questions. Let's see. We had how to decide on risk percentage. So just to answer that question, actually, because I don't think I actually really did it specifically, is you want to work out, obviously, the account size you're trading. You want to work out what you're comfortable with. What are you comfortable with losing? Be honest with yourself. So maybe you're trading a 25K account with us and your 1% would be 250, right? But maybe you're not comfortable with risking 250. Maybe you only want to risk 125, 0.5%. Maybe you want to risk 0.75%, right? That's where you have to accept what are you willing to risk. Because once you accept that and you know what that figure is, it's going to make it a lot easier for you to follow it. Because if you're not comfortable with risking 250, but you put in your plan, I'm risking 1% per trade, you're going to struggle with it, right? Because you're always going to be watching your charts and watching your trades because you're not going to be actually accepting the amount you're risking. That will help you to decide on risk percentage. And then also knowing what risk to reward model you're going to be using. Some people use that 1 to 10. Some people use that 1 to 3. Some people have 1 to 2. So then you have to work out as well, if I'm using a lower one, do I need to adjust accordingly? If I'm using a higher one, again, same thing. Do I need to adjust accordingly? So let's say if you are one of those people who's using a 1 to 10, it doesn't mean you have to use a 1% risk per trade. All right. Just for example, you could use, 0.2% risk per trade, for example. So when you win that trade, that's a 2% trade, but you're only risking 0.2%. You see how it sort of the numbers change depending on what scenario you're in. So it makes it a little bit difficult to answer the question, but I hope it answers it for you. Let me have some water, as you can hear, struggling. I can check, yeah. I don't think so. But I can check. Is anyone in this webinar is fairly new in the last 2 months? If so, Marco is hosting the welcome call with Nat as well. So if you want to jump off this webinar and join, obviously, that webinar, by all means, this is being recorded. So this will be uploaded. Let me check. Yeah. So if anyone is new within the last 2 months and hasn't been on a welcome call, please go ahead and you can leave this one. No problem at all. Where are those questions at? That's fine. That's fine. Maximum losing trades, even though risk management is good. Maximum losing trades, that's, again, it's going to have to be a number you're comfortable with, right? In a day, in a week, in a month, whatever it may be. So for some, that might be, say if their risk per trade is 1% and they've said, I don't want to lose maximum in a day or in a week of 3%. You have to set these things in place beforehand. Because at the end of the day, it's about taking the step of not leaving room for discretion. And this is what the trading plan was all about as well. That's why we had a losing streak in there. Because if you select in your losing streak strategy, how to handle that is, of say, okay, I don't want to risk more than 2% in a day, for example, right? If that's the case, then 2% in a day, if that happens, you have to be willing to step away, right? So actually, if you didn't have that in play, what I'm getting at is that you then leave room for you to then take 3-4 more trades. Now, obviously, there's a difference between you set the 2% risk on the day of what your maximum loss you're comfortable with is, but then say, you go over that, right? Are you disciplined enough to not go over that? Because that's a separate issue, obviously. That's separate to risk to reward or risk per trade or risk management. That's about discipline side of trading. And we talk about a lot. How to join, please. So if you have been obviously joined in the last 2 months and need to join that, the links will be sent out. But let me check. Let me check one sec. Where will they get links for the people who need to join it? Oh, it's sent in the Hit Squad group, so it's done. Oh no, he sent it into. You can put it in. All right, Joe's gonna put the link into the Hit Squad group. So if you need to join on that webinar, then by all means, join. Yeah. What's this? No worries. What we got here? Sorry, just gonna go through the question. That was one. I hope that answers your question, Imran. Will you run through how we calculate our position size according to risk? You can do so. There's an app called Stinu. I'll pull it up here on my phone. 1 second. So Stinu here, for example. So where's my camera? It's over here. Can everyone see my screen? It might not be clear though. I do apologize. But essentially, you can type in. I don't know if you can see the screen. But it's called Stinu. So Stinu is, if I type in the chat here for those who haven't got it, Stinu like that. Okay. So what it allows you to do is put your account balance. So say it's 50,000, for example. Your risk, so it could be 0.5%, 1%, whatever risk you're comfortable with. Your stop loss in pips, right? So let's say 10. Now what happens is, if I go on GJ, for example, I'm trading GJ, it's going to tell me what lot size to use, right? That's it. It's going to tell you what lot size to use, because it will be different depending on the pair. So as you can see at the top of, no, you can't see actually, but you can type in Pip Value Calculators to work out obviously the value of per pip depending on the pair that you're trading. Okay. When to set break even? So break even, that was under the structure webinar. So if you think about, for me personally, it's a personal thing. At the end of the day, it's about what works in your strategy. For me personally, I get break even after a breaker structure and a retest. So for example, something like this. So say we're in a bullish market. Okay. Say I'm looking for the retracement. I've entered, I don't know, here, right? I'm not going to go break even until price has moved away, created a new structure. So as soon as I made that new structure, that new low, I know that I shouldn't come back here. So that's when I go break even personally. But I know people go break even, after a certain amount of pips, after a certain key level. It's all based on what works for you, right? But that's my advice personally. Because if you notice, a lot of people do say, oh, I get taken out break even, and then it goes my way. So for example, say, we're entering, I don't know, here. Okay, so entering here. Price moves away, comes back, makes a double bottom, takes people out break even, then shoots up. Yeah, happens a lot. And a lot of big reason for that is the structure side of things. It just needs to make that retracement. Sometimes the retracement's slightly bigger. So it's not so in a downtrend, for example, it's not just a clear low and then another low like that. Sometimes it does create that sort of double bottom. And if you look back on the certain charts, you'll see this happen a lot, where it creates that sort of resistance there and then comes down. So yeah, hope that answers your question. Reduce risk if you're on a losing streak, 10+ trades. Yeah, you can. Don't get me wrong. Now, the hardship is that if you are on that losing streak and you reduce the risk whilst you're on it, so especially towards the end of it, say after 10 trades, the problem is when the winning streak comes back in and then the strategy is back in play, now your winners will be less. So then what normally happens is it kind of just ends up being a break-even stage of your trading career, because you end up something like this. So if we write it out, so say, at the start, when the losing streak began, you were risking 1%, and you're using a 1-to-3 model. So you've lost out of 10 trades, you've lost obviously 10%, right? So yeah, we'll do that, right? On this side, however, say you've then gone in, you've had the losing streak, you've changed to 0.5% risk, all right? But then that 1-to-3 model is still there, so you end up winning 10 trades at 1.5% each trade. So you're still profitable overall, to be fair, in this scenario, if I've got it correct. Let's think 10 trades, 1-to-3, 1.5, 10 of them. Yeah, 15%. So in this scenario, it actually still works out, which is good. Let me just make sure no one in the comments is like, your maths is wrong. That could be wrong. Gotta shoot. No worries, Jay. No worries. Yeah, so in this scenario, it actually works out to work out still. But it's not likely, though, that 10 trades in a row are going to be losing and then winning, right? Normally it's a bit more random, but there is times like that, to be fair. But you can see how by reducing the risk, though, it's giving you 15% on this scenario. But however, if you were keeping it to the normal scenario, that would be 30. That would be double. You've capped yourself in half. So you're willing to lose the 1%, but then you're not willing to then, go on. But don't get me wrong, it's not a case where you want to just continue to lose and keep with the same risk just for the sake of it. You want to obviously manage those scenarios sort of uniquely. Work out why you're on such a losing streak. What is going on with that? Why is that happening? And react accordingly. So you might need to reduce your risk down, but do it in a way where it's not going to cap your growth or affect your growth in such a drastic way. If that makes sense. Sorry. When to increase risk? Increasing risk, I would say with your confidence. So say if you've gone for the beginning of, say, risking 1/4%, 1/5 of a percent, 0.5%, whatever it may be, knowing when you want to then feel the confidence of moving up to that next level. So say you've been confident in 0.2% risk per trade, you just started off, you're starting off slow, like building it up, and then that 0.2%, you managed to, consistently be profitable with that, following a plan, with that strict risk management for, I don't know, a month, 2 months, whatever it may be, when you're feeling confident. Then you can look to increase, accordingly. You don't want to go from 0.2% to 1, right? You don't want to just quickly jump. You want to do it strategically in steps so that your mindset can adjust to the new amount of risk on the table, and also with the new amount of profits that can be made according to that risk too. Do you immediately enter after a retracement? No, I don't immediately enter. So again, so that for the scenario, so just for example, this is not really risk management, but say it's not 61.8, let's say that was 61.8. I'm not just going to enter. I'm going to be looking at structure. Maybe this fib is on a 4 hour, so I'm going to be looking at a 1 hour or 15-minute structure around this area, right? So I still follow exactly what I said in the structure webinar. How do we determine what we are risking for different pairs? So that again, Pip Value and the Stinu app will help with that. Stinu, yeah. No worries. Cool. Any questions, guys? Any feedback or anything? Because risk management is a bit of a smaller topic, not much to focus too much on. I just wanted to give some examples of the importance of a strict risk management system. The first 3 webinars we've done, Masterclass webinars, have been mainly on the foundation of trading, in my opinion. So, strict risk management system, strict trading plan system, and obviously the structure of price. They're my sort of where I focus at the most. And that's why I've shared and tried to focus on that first. And then hopefully from next week, we'll start going into price action based webinars. So I think Fibonacci will be next week. That'll be probably the first one that we go through. And then we can take it from there. Good risk management overriding becoming an excuse to enter trades. It's only 0.5%. I'll take the trade. What do you think about this as a cause of this? Yeah, no, 100%. So good risk management doesn't mean you can just jump into trades because you've got maybe risking a small amount or anything like that. Good risk management is just about knowing that every trade will have a fixed risk in place. It's still going to be used according to your trading plan. So the risk management shouldn't be the deciding factor of getting in or out of a trade. The trading plan is number 1. That's why we did that first. Guilty. And we've all done that though. We've all been there. I've been there. Even I have. Like, there's been days where I've made, say, I don't know, 20%, right? But then I'll be in my head that I can risk 2% now. I just made 20, isn't it? But that's not the mindset we want, because it instills bad habits. It instills us to make poor decisions in the market, right? It instills us to make poor decisions in the market, right? What made you that 20%? What made you that 10%? What made you that 5%? What made you those returns in the first place was because you stuck to a plan, because you had strict risk management, right? And the thing that happens is, so for example, when trading small accounts, going back to that example, is that the reason why a lot of people continue to do the bad habits is because they will do it once and it will pay off. They'll be lucky. It'll pay off for them. So then they'll keep doing that because it happened once. It can happen again, right? What they don't let that happen to them, though, is that every blown account, it just for some reason doesn't instill in their mind like that blown 10 accounts. So maybe I'm doing 10 things wrong, right? They should just be focusing on what is achievable for them, right? And what made them successful in the first place. So if they haven't got a plan and they won't know what made them successful. They'll just be like, okay, I'd read, maybe I did support resistance, boom, that worked for me this one time, but then the next 10 times hasn't worked for me. And that's why having the strict plan that you follow and then have the risk management accordingly for when you take those trades. That's all. The risk management shouldn't be the deciding factor of the trade, if that makes sense. So as in like risking 0.5% just because it's 0.5% in your eyes. Because bear in mind, remember, so 0.5% is on 100K is 1% on a 50K account, and it's 2% on a 25K account, right? So your 0.5% might be a crazy over leveraged trade to someone who's trading in smaller capital. So you have to remember that as well. It's only 0.5% to you, but that shouldn't change that. That shouldn't affect how you trade. You shouldn't let that affect you. If it is, then that's something that you have to sort of think about and sort of try and work on if you want to go to that next level. But any other questions? We've got maybe a few more minutes. So any other questions? It doesn't have to just be about risk. You can just throw them out there. But if not, then all good. I hope this was an enjoyable webinar, a little bit different. If I want to make an aggressive risk, if I want to make an aggressive risk, don't know what that means, Peter. I want to make an aggressive risk. Just break that down for me. I'll answer it, no problem. How many pairs do you personally trade? I personally trade very few. So I look at GN, EG, maybe 3 or 4 pairs max, but I only trade normally one at a time. So if I'm in a trade on one particular pair, I won't trade any other pairs. I won't even look at them because I just want all my energy to be focused on that particular pair. But that's me. That's me personally. If I want to make my risk higher, if you want to change your risk amount, again, that's something that you have to follow your plan and your confidence in how you feel, right? If you want to do that, the way you do that is obviously if you're risking, I don't know, 0.5% now, you're going to then go to say 0.75% and so on. You think it makes sense to assign percentage risk to setups? For example, risking 1% on an A grade setup, 0.5% on B grade setup. Not personally, I don't. Personally, the only way I change is if I'm doing a counter trend trade to a trend trade, right? So if I'm doing a trend trade, I'll do my normal risk. If I'm doing a counter trend trade, that's the only time where I might look to adjust my risk per trade, but normally no. But an A grade or B grade setups, personally, I don't do that sort of thing because I'm only looking to take A grade setups. I'm not looking to take any sort of B grades or potential setups. I only want to take the best. Because otherwise, on that B grade setup, I'm always going to be stressing because I'm going to be like, oh my God, I didn't have the most confidence. So yeah. So if you guys want to see what I get to see every yeah. Any other questions though?
Why is there a 4-hour gap?
Did answer. Did you see it? Thanks, Chris. No worries. I hope this was enjoyable for you and useful. I don't know how Dundon got home so fast. He made it. Pain. Awesome masterclass. Fantastic. I'm glad. That's what we're here for. Tomorrow we have back testing. We'll try and do something a little different there. Who's up for, if anyone in here is going to be on the back testing, who's up for leading the back testing tomorrow? Dundon, I heard your name was in the hat. What? You shaking your head? What? I saw your name.
No, not happening.
Are you sure?
Definitely not.
No worries. Someone will come forward. If not, Benno's going to do it again. Look, he's like, no, not again. Not after last time. You're right, Riz. No one talks. That's what Benno's saying. But that's cool. We'll see you tomorrow. I'll pick someone tomorrow. But I'll do some as well tomorrow as well to make up for last week. But no, I'm glad that you enjoyed this. The recording will be in the group. What time is it? 20 past. I'll try and put it up now. If it downloads onto my laptop, I'm still here for a little bit. So yeah. But appreciate everyone. If you want to obviously shout the webinar out, by all means do so. I will not stop you. But I'll speak to you all soon. And Don, I'll see you tomorrow. Hopefully you're gonna be on the floor, right? Yeah, Don. I'll see you there.
Yep, I'll be there. Yeah.
100%. All right, man. See you guys later.
Right.
Take care.
Thanks.
Appreciate it.
Bye-bye.